Hello, I'm Rachel, editor of Moneywise. Today I'm here with Rachid Semaoune, a manager of the Royal London Global Bond Opportunities Fund. Thank you for talking us through it.
Thanks for having me.
I want to know, first of all, what does the fund do? Why should investors consider it?
It's a fund that offers great income. The main objective of the fund is to generate some high level of income on a very consistent basis. And in the current interest rate environment, by high income we mean an income yield of around 5 to 6% per annum. So this is very attractive, especially if you compare to the rates you're getting on your saving, your ISA. So anything pays you next to little. So to have 5 to 6% income yield on an annual basis for a very long time is very attractive.
How do you do it?
We've got that great investment process in place. It's been developed in-house, and our investment philosophy has proven to work and deliver strong outperformance on a very long-term basis. And not only for this fund, but for all of our Royal London funds, for different strategies, our investment process has delivered very strong performance. And I am applying the same investment process for this fund.
Okay, so we should be clear that the fund invests in bonds, so companies will issue both debt and shares.
That's right.
And you go just for the bonds, the debt side
Correct.
Of things. And how do you pick which companies' debt you want to invest in?
First of all is we're looking at the higher part of the market where we want to achieve a certain level of income, and also we put great emphasis on security and covenants which are embedded in specific bonds. And by covenants, these are a set of legal languages which tells you what the company can or cannot do. So it gives you a certain say over the destinies of a company, and we like that because it can prevent the company from having more debt on their balance sheet, for example. And also, our investment process is very unconstrained. So we are not bound by a benchmark. We can buy unbenchmarked bonds. We can buy bonds which have no rating. We don't mind illiquidity.
Can we just quickly talk through both of those? So,
yes.
So no rating. There are lots of rating agencies that will say how likely a company is to pay that debt back.
Yes.
And you'll go for some bonds that do not have that rating. Is that what we're talking about?
That is correct.
And liquidity is the ability to sort of
buy and sell very quickly.
Well, so people put a kind of emphasis on liquidity.
That's right. They tend to overvalue these attributes. Yeah. They tend to overvalue liquidity, so they're prepared to pay up more than what they should just because they think a bond is liquid. And liquidity is a very transient attribute. I mean, if you look, for example, back during the European crisis in 2011, the European Investment Bank, which is rated AAA, so the highest rating, these are bonds which are deemed to be very low risk. But during the European crisis, when they would talk about the Europe breaking up, these bonds actually underperformed and you couldn't sell them. So what's liquid at a certain point in time might not be liquid next.
Okay, so it's about you using your own judgment, not relying on the ratings or perceived levels of liquidity.
Yes, we believe that ratings do not tell you the whole story.
Okay, so if you can find something that is rated lower, and so then you get more for investing in it because it's seen as higher risk, but you feel that actually it is safer, then you're likely to get a better deal.
It's all about finding the bonds which offer the best risk reward return. So to have the right balance between the risk you're taking and being well paid for the risk that you're taking.
Okay. So give us an example then of something that you're investing in that you're excited about at the moment.
Recently we bought a bond of a company called Jacktel. It's a bond which is denominated in dollars, and the bonds are secured on an oil platform which is located offshore Norway, and the platform provides accommodation for the oil workers. And the bonds are secured on this platform.
What do you mean secured on?
It means that if the company defaults, then you take possession of the asset.
Okay. So you
you've
get
got
this
great-
floating hotel
you
if
get
they
this
don't
floating
pay
hotel.
out.
That's right, that's right. And currently, this floating hotel, which is the right description for this type of asset, is being leased to Equinor. And Equinor is the state-owned oil and gas company by Norway. So, and the Norwegian state is AAA rated, highest possible rating that's out there. So it's a very credit-worthy counterparty, as we call it. So you've got this great asset, which is operated by this great company, and the bonds pays you 10%. And you're going to ask, why 10% per year? Well, because the bonds are unrated, so they're not on benchmark. So most fund managers do not tend to look at unrated bonds for this reason. And also, it's a very small market.
Okay, so it's, I guess, the nature of your fund that you can look at all sorts of different types of bonds.
That's right.
Rated, not rated, all across
That's right.
mature markets, emerging markets, all over. So
Yeah.
you can pick and choose, whereas other fund managers might have restrictions.
They have restrictions which are imposed by the benchmark.
What do you mean by the benchmark?
Benchmark is that their performance is measured against an index. So they have to more or less stick to the index. Whereas for us, we don't have an index to benchmark our performance. Our objective is just to deliver some consistent high income on an annual basis. So I can go off piece. It's totally unconstrained. I can be globally diversified. I can be currency diversified. I can be diversified by sectors. I can be diversified by credit rating or by unrated bonds. And at the moment, we've got this good mix within the portfolio, which allow us to deliver this great income.
So it all sounds completely rosy, and obviously the fund is doing very well at the moment, and we've just added it to our list of first 50 funds for beginners. So tell us about a boo-boo. It can't always be that plain sailing. Tell us about a time when it's gone wrong.
Well, I mean, during the Lehman financial crisis in 2007, I bought the Lehman bonds like a week before, believing that the bank was too big to fail and that the US government will bail them out and that it will be all fine. And unfortunately, over the weekend, just before, if you remember, Lehman filed for bankruptcy on a Monday, and the US decided that they were going to bail out Merrill Lynch because it was an even bigger bank and they couldn't let that one fail, and they decided to sacrifice Lehman to the altar. So that was a very terrible investment decision.
You
So
weren't the
things do
only
go
one
wrong.
to
I
make the
wasn't the
too
only
big
one.
to fail mistake.
That's right.
Can I ask you about your ESG considerations, or how that factors into your decisions? So, I mean, however we call it, environmental, social responsibility.
The fund is ESG aware. So we take that into consideration, especially on the governance side. This is something that we've always looked at. It is embedded in our investment philosophy.
Okay, so you look at less on the types of investments, but more on the boards.
Yes, yes. We've got our own ESG team, which does the work on the governance side, the social impact and the environment impact, and we do take that into consideration when making an investment decision.
And final question, because lots of people, I think, starting out investing will wonder, tell us about a day in the life of Rachid. What do you do? How do you go about, you've got what, 180, I think you said,
Yes.
Bond investments. What do you do all day?
Well, my day starts with a very good breakfast, first of all, and that's important. Yes, exactly. And so the first thing I do when I come in the morning is looking at the news. You have to be news aware. So I check my position, I look at the news, if there's any significant news overnight at the company level and also at the macro level. So I'd like to be informed about what's going on in the world, the trade wars and the progress on Brexit. And then I'll be looking at, there's always a lot of new issues coming to the market, companies looking to issue bond, and so I go and attend a lot of companies meeting. Most of the days I meet management, we discuss, I tend to go to conferences. I do a bit of trading as well, of course, when we have some inflows. So it's very, very different every day, but we try to stay as close to the market and as close to the companies as possible.
So scoping out all the time new potential companies to invest in.
That's right.
Wonderful. Thank you for talking us through that, Rachid.
Thank you very much, Rachel.